Can somebody let me know if you guys can hear me?
Yes, you are audible.
All right,
Yeah, you can hear you.
cool. How are you guys doing?
We all right. We all right.
Awesome, man. So
What
I've
about
had
you?
some people reach out to me and ask me if I do a Q&A for the non-members, and I decided to do one right now. We'll see how it goes. I may do another one in the future. I don't know yet, but yeah, if you guys trade the same style as us and you got some questions, this would definitely be the time to ask. Does anybody have any questions to start with?
Yeah. I wanted to ask, in your opinion, what works better, chalk or maybe a chalk then a breaker for supply and the demand if you want to go counter trend? Because sometimes you get a chalk, then you get burnt.
So I just actually not sure if you've seen it, but I threw our latest group's Q&A that we did from last week from our premium members. And the first thing we talk about was the different types of chalks. One of the things we've implemented was, let's see if I can find an example here. So the traditional chalk, the way I was always taught when I came up, I was always told, you know what, let me just find my drawing tools, 2 seconds, guys. Wherever they went. Oh, they're there. All right, so the traditional chalk, we were always taught that if you had a wicks to the downside, we never waited for a body break. We could have wicks to the downside, we could have wicks to the upside, and then all of a sudden you pulled this as a demand zone. So that's the way I was taught by multiple communities, multiple coaches. Something I've implemented lately. Let's actually, let me silence that. Maybe I can't. Anyway, something I've implemented lately is rather than just waiting for wicks to the downside and wicks to the upside, we started using body breaks to the downside and body breaks to the upside. Now, this has done 2 things for us. It's reduced the amount of trading opportunities we get in a day. It definitely has. There's way less trades, but we also noticed we ran this across all 4 pairs you guys see on the screen. I ran these numbers through all 4 pairs, NASDAQ, gold, euro, and GBP USD. And on every single pair, our hit rate went up over 100 different trades during a back testing session. So with that data in mind, we're testing one other theory right now. So what I'm doing right now is 4 entries. You have your traditional chalk, and then you want to get tapped in. So 4 entries, I want to see this to be a body break, and I want this to be a body break as well. For the 10 to 30 M chalks, to tell you we're going in that direction, for the most part, what I've been doing is the same thing, is body breaks in both direction. However, if I can see wicks on one time frame, I will start cycling through 10, 11, 12. And suddenly, if we actually look here on the 12-minute, I do get a body break. So now I can use this as a chalk area. So if I cycle through 10 to 30 and somewhere I can find a body break and on both of them, then that becomes a valid chalk. Now, this is the highest hit ratio we've had. The other thing we've been testing is wicks to the sweep side and a body break in a direction that we want to head. This is something I'm still testing. I'm only using this on 10 to 30 minute. For the entries, I'm still using body breaks both direction, but none of our coaches are using just wicks anymore, and we've gone away from using just wicks. I know some of our members are still using wicks because it does get you into more trades. But like I said, do you want more trades, or is the trade-off to having less trades but higher quality better? So that's kind of where we went with chalks, is we're looking for body breaks in both directions. like I said, this is a subjective thing. I'm also not against wicks to the downside and a body break in the direction we want to head. So if we want it to head down, I'm okay with wicks to the upside, but to the downside, I still need a body break because that's the direction we're heading. So that's kind of where we've gotten to with chalks lately. And it's definitely something to test for yourself. I can already tell you your results when you back test this. Your hit rate will go up. Your amount of trades will go down. Just by adapting this rule too, and starting to use more 4-hour trend than anything. I've now been able to go from looking at 1 pair to looking at 4 pairs because my entry criteria is so tight now that some days 4 pairs don't give me a trade. Other days, you know, like there's 4 or 5 setups on 4 pairs. Whereas before I used to find like 3, 4, 5 setups a day on Euro USD just using wicks. And like you said yourself, the hit rate was quite a bit lower, but it does work. So this is all again to you as the trader to take this information I've shared with you, go back, test it, and see what you think works for you. There's definitely some good and either side of it. Myself, I'm more about the hit rate right now than I am about finding a trade every day. I'm okay with taking 3 trades one day and 0 the next if that's what the market presents. I don't force trades. So that's where I am with chalks right now. Do with that information what you will. And, you know, I hope you do test it. I think you'll see an improvement in your own trading. Does that kind of answer your question?
Yeah, it did. Thank you.
All right, all right. Do we have any more questions from anyone else? Don't be shy, guys. You joined here to ask questions. Let's get them out. Somebody here must have a question. Does anybody have a chart you want to share maybe and ask a question? Because I'm not against letting somebody share their screen if that makes it easier for you to get your point across.
Hello.
Hi.
My name is Mike Wasanti. I'm from Ghana. I wanted to ask a question. I've paid for numerous of mentors that actually teach institutional trading, but from time to time, I've been seeing that the pattern is just the same, that just go to your higher time frame, look for your other blocks, and maybe your break of structure and all those things. So right. I was asking, what do you bring to the table which is different from all these mentors?
I'm not sure I fully get your question. Like, are you asking like what my, like, how do I set up? How do I analyze? Like, I'm sorry, I missed some.
Yes. How do you analyze? How do you come to the market? The mindset you have, those type of factors.
So for me, I look at 4-hour and I look at 4-hour expectational order flow. To give you an example, this is 4-hour structure. So if I came to the market and this high got broken and we put in one high, my expectation is the market is going to retrace and the market's going to make another high. Now that this high is made, my expectation is once again a pullback and a continuation. And basically my expectation is for the 4-hour trend to continue until it doesn't. And the other thing I look at is momentum. So here we have very aggressive momentum down. Here we have very corrective bullish price action. What we can determine from this is likely a daily or a weekly pullback. The reason I say that this is a daily or weekly pullback and it's likely to end is because we did not see any momentum. If the banks were going to go up from here, you would see something like this. Rather than that, we've seen this. Anytime you see sideways stuff, you know it's going to end. So with my interpretation, I start going to the daily and the weekly, and that'll tell me where the 4-hour trend will likely end. Now, if we look exactly what happened here, if I just pulled my fib on this, I can pretty much guarantee you that what they did, let's see, what they did here was they came and mitigated 50% of the daily fib, and now the order flow continues. Because the way I look at it is if daily and weekly is bearish, that trend is likely to continue. So even if 4-hour turns bullish, it's likely a daily or weekly pullback. But anytime I look at the market, it's always, what is the market doing? Okay, we put in a high. As soon as this high's run, we expect a pullback. Once the pullback's complete, we expect another high. So at some point, like I said, once you get above this 50% fib on the daily, we know that buying becomes the lower probability. We determine this by momentum. Like I said, if this went straight up, then my expectation would be that we keep going up. This had trouble going up and barely made new highs. And as soon as it was time to go down, look at how quick and how aggressive we came through that. So now we made a new low. As soon as this new low is made, the expectation is once again a lower high. Once the lower high is printed, a lower low. So I come to the market with that thought in mind. So if I get to the charts, and the last thing we did was we put in a new low here. If I come into the market on Mondays, my expectation is some sort of a retracement and a continuation. Then another retracement and a continuation until to such a point where the 4-hour fails to make a new low, and then the 4-hour runs the high. At that point, my expectation would be for the 4-hour to go the other direction. And then I would look to the daily and weekly to see where that trend would end. So now what I do with this 4-hour information is I'm going to go down to the 15-minute time frame. And on Monday or Tuesday, I guess will be the real trading day, because Monday is not a lot of volume. As soon as the anything 10 to 30-minute chalks, my expectation is to continue up and play the retracement counter 4-hour trend. At some point, we're going to hit a supply zone, either 2-hour, 4-hour, half hours. We're going to hit a zone somewhere, and that zone's going to turn the market around. And chances are that market will continue in the same direction. Now, I don't bother predicting the market. I analyze with what I see. So if Tuesday we come to the market and we get a new 4-hour high, the expectation is going to be a pullback and another high. And that's all we can do is have an expectation of what's likely to come with what prints. Like, I'm not going to sit here and be like, this is what's going to happen next week, because that's predicting. And if you start predicting the market, you look at the market in the wrong way, basically. You're trying to be a fortune teller, and nobody knows which way the market is heading. The only thing we can do is analyze momentum, analyze candle sizes, analyze if we're putting in lows or highs. And every time a low gets made, we know there's a retracement. Every time a high gets made, we know there's a retracement. So like the way I trade is if I got in somewhere here, I would look to keep trading up until that high's run. Once this high is run, I will no longer keep taking buys from here, because I know at some point the retracement will start. And if this pair ends up going up for another 2 days and I don't want to keep buying, I'm not going to keep buying till I see some sort of a pullback on a lower low prints, or a higher low prints, I mean. So this is where I'll likely go to another pair and find something that aligns with my trading plan. Does that kind of make sense?
Yes, please. You see the first impulsive move followed by the second impulsive move, the break of structure between that lane. How will you identify your order block? Because you can see that the market was choppy before we saw the impulsive move. So how will you define or see your...
How to identify that it's going to drop here?
Yes, or maybe there's a order block, a possible order block, which will have a reaction upwards.
Well, this is where I'll scroll through 2 to 4. If 4 hours doesn't give me a clean point, I think this actually ended up reacting to a daily zone, and it did. Yeah. So as soon as you start looking at it, and your 4-hour structure's gone, how do I explain this? if you're looking at the daily being bearish, once we get above the 50%, buys become lower probability. The reason they
Okay.
and the way I look at it is it's gonna go down either off this, or I'll pull this zone here. It could come up here and drop. But at some point, I do expect that to drop because there's no real momentum here, right? Like if you look how aggressive this came down, if they were gonna go up, it would have gone up just as aggressive. They didn't do that. So I always look at how the candles print on the 4-hour and the daily, and that kind of lets me decide what's the market gonna do. It's no different than here. We did turn bullish on the 4-hour temporarily, but again, sideways corrective action. And we came through it aggressively. Here we went up aggressively, but we failed to close above that. So now this becomes a weak low. And at this point, you turn your bias back around and you look to short the low out. The only thing we can really do as traders is identify the zones where the market will likely react, and then we wait for that reaction. So inside this daily zone, I'd like to see, at least a 15-minute chalk. Now, in the event that the 15-minute chalk happens, let's actually go look. In the event that the 15-minute chalk happens and doesn't give you an opportunity in, so in this case here, if you scroll through enough time frames, you would likely find, you know what? Let's just do that right now. We're just gonna. So this would be my chalk for me here. You ran the highs, ran the lows, but right now, I would basically cycle through any of these and see if anything got me an earlier chalk. So here I did get an earlier chalk on the 12-minute. So now I can go back and look and investigate and be like, what caused this break? And I can assume that something within this zone did. Now this is kind of a gross mess. You see a bunch of candles like this. So once again, at this point, I will start cycling through time frames. Okay, 15 looks a little better. We go to the 30-minute. 30-minute looks a bit cleaner yet, right? And ultimately now I'm going to go down on the lower time frame and look for an entry in here. Now, if you missed the original entry, the next thing I'll start looking at is where's the next demand zone? Okay, cool. What broke this demand zone? Likely something in this supply. Now I know this doji here is it's not a buy candle before a sell candle. So now for me to consider this a supply, I have to scroll. So on the 14-minute, I do get an up candle. Now I can look at this as a supply, because if we look to the left, this was our demand. This is the supply that flipped it. So now this becomes a valid zone to look for sells. And ultimately, that's all I look for is I mark out zones. I mark out what's breaking the zones. And if I can figure out what's breaking the zones, that becomes a possible area of entries. So for example, even this zone would be absolutely valid to me. Now, I don't know which zone the market's going to tank off of, but I know that if I have 2 or 3 zones marked out, and if the market comes back to one of them, there is a more than likely chance that the order flow is going to continue in that direction because we're bearish. You can never tell which order block for sure is going to give you that move, but you can usually get it down to, it'll be this one or this one. And obviously the more it retraces, the higher probability the sell is. So hopefully that kind of makes sense.
Yes, sir. Thank you.
You bet. You bet. Does anybody else have any questions?
Yeah, I wanted to ask mainly on session timing, the difference between is it London low and actually London session, and what 3-hour windows you advise to trade, through backtesting and data.
So for myself, and I've analyzed this for myself, you can see I switch my time to UTC +1, which is London time. I actually live in Canada, so it's 12 o'clock. It's lunchtime here, but I still run on London time. And for myself, I trade from if I was going to trade London, it would be from 7 a.m. London time to 10 a.m. London time. For New York, anything from 12 o'clock to 1600 is your highest volume window. So the higher the volume, the higher the probability of your trades. Now, this falls true for Forex pairs, gold, but if you're trading indices such as NASDAQ, indices mainly move from the New York open to the New York close. And all you'd have to do is look up what time the US stock market opens and closes in your time zone, and indices pretty much move all day. Does that kind of answer your question?
Yeah, thank you.
Cool, good stuff, guys. Just kind of curious, does everyone in here trade supply and demand, or is some of you guys looking to switch over trading systems? Quiet bunch, hey? And to answer your question, do you usually wait for inducements? If inducement's intact, I do prefer having inducement involved in my trade. However, if there's enough momentum there and there's no inducement, I will still trade off that zone just because the momentum there is. And momentum, again, is big candles that engulf the previous candles. So if I see that, I don't need inducement. If the momentum's sort of there, sort of not, I would rather trade off a zone that has some sort of inducement because it's got a higher probability of holding. My question is about wicks. When do we consider them a possible supply or demand? That's actually a really good question. So myself, I love wicks, and they're the same as an engulfing candle. So if you can find a wick on one time frame, if you scroll through a bunch of time frames, more often than not, you will find an engulfing candle. The way to use wicks as supply or demand zones is that wicks got to follow through. So if I get a long wick, I need that momentum to follow through. This becomes a demand zone. Now, if I get a long wick, but it just kind of goes sideways and it doesn't break anything up here, this is not a demand zone. Just like any other supply or demand zone, if you're going to use a wick, that wick has to break something. If it breaks structure, it is a really good POI. If it breaks substructure, it's a little weaker POI, but it's still a good POI. But either way, it still needs to break something. If it didn't break anything, it is not a supply or demand, and I will not trade off that zone until something is broken. It can be something as minor as some sort of a substructure break. And if you start utilizing these rules of it has to break something, you're going to find yourself, you're going to have stronger zones to trade off of. And the stronger zone you trade off of, the higher probability the zone has holding, which ultimately gives you the highest probability of your trade going in your direction, providing your analysis is correct. Premium and discount. Premium and discount, I pull on 4 hour. I used to look at it on the 15-minute and half hour and 1 hour. And now that I've done more and more testing, I've just realized 4 hour structure is the most important thing. 4 hour pricing is the most important thing. Like I enter on the 15 or the 30 second, and my trade bias all comes from the 4 hour. If the 15 is bullish, cool. That's a 4 hour pullback. If the 15 is bearish, cool. We're in line with 4 hour trend. I will keep shorting that. I know that if I get an entry somewhere in here, I can short this 4 hour low out. Yes, I do use divergence for entries, but I don't use them in the way you think. For me to use divergence, it needs to be, it's a second confluence. What I mean by that is I need my 4 hour time frame. So we tapped into a 4 hour here. If we look to the left, we can actually here, I'll tap this. If we look here, we tapped into a 4 hour. You can even refine this latest zone because it broke something. So I'm more than fine of using this one. So this is a strong zone here. Put in a new low. You have your inducement intact right here. So for me to use divergence, I'm gonna look at the 15-minute, and it'll be the same thing we went through before. I think it was the 12-minute here that we found the chalk on. I still need that higher time frame chalk. I still need the lower time frame chalk to enter. Now, if divergence happens to appear along with my chalk, that just means it's a higher probability trade. A divergence will appear anywhere you're making new highs here, but your RSI is not. What it means is you're close to the top, but the top could be here, could be here, could be here. And ultimately, you got to go back to your 4-hour zones and waiting for your chalk. And only at that point can you align everything and be like, okay, my chalk is there, the momentum's there, and we got a divergence. This is a higher probability trade because not only does price action align, but divergence appeared with it. So the only way to use divergence is to use it as a secondary confluence. If you trade every single divergence you see on any divergence indicator in the long run, it will burn you. But what it can do is tell you you're close to a top or a bottom. And that's how I use divergence. But let's just to give you an example, if I go on my entry time frame here, you're gonna notice the divergence appears lots. So divergence appeared here, divergence appeared here, divergence appeared here. So here you finally do get your chalk here. Whoops. You finally do get your chalk here. Only at this point would I consider this a POI, and would this divergence mean anything? This first divergence that happened, it didn't break anything, so I completely disregard it. I only have one type of setup, guys, and it is I pull my POIs, I wait for a chalk and flip in it, and I will continuously execute that setup. And now that I'm looking at multiple pairs, I will use the setups that have the higher momentum, the highest momentum, or the best probability of a trade going. Do you consider imbalance? I do not. I do not. Imbalance implies momentum. So right here, there's a lot of imbalance. I know that if the market came back to this POI, this will likely give me a reaction and give me a sell down because there is a lot of momentum. Now, if you start going along and start marking every single imbalance that you see, there's imbalance here, and there's imbalance here, and there's imbalance here. All imbalance implies is momentum. So the way I use it is I recognize that there's momentum there and that I'm willing to use the zone. I don't sit there and mark out every imbalance zone anymore. I used to, and that's when I came up with the theory imbalance implies momentum. If I just look at where the momentum started, that's my supply or demand zone. I'm more than happy to trade off of it. So let's say we tap a 4-hour supply or demand. Do you always wait for a chalk to confirm it is valid? Yes. So back to our 4-hour question. It is no different. It is no different if it's 4-hour or 15-minute. The validation needs to come from your higher time frame. So let's look at this logically. We ran this low here. We came down. The expectation is a retracement. There is a higher probability of this supply holding and the market going down than there is this supply failing. There's nowhere else for this to go. If it goes any higher, it's going to change structure. Yes, it can wick above and then go down, but what we're counting on is the 4-hour bearish trend to continue on going down until it doesn't. Do synthetic indices obey kill zones? No, they don't. No, synthetic indices are their own thing. What else did we have? How many setups do you use, and do you enter the market without the confirm? No, I don't enter the market without lower time frame confirmation. It's I would look for a chalk in here. I would look for another chalk and flip on my 30-second or 15-second. And the next thing I'll look for is if I happen to miss the trade because it dumped without me, I will look at the next higher time frame flip zone. And I'll just basically pull all my higher time frame POIs and I will wait for the market to come back to it. If it doesn't, I don't need to be in a trade. Not every day is a trading day. And the sooner you can realize that, the sooner you'll stop forcing trades, the better you'll start doing. Cool. Does anybody else have any questions?
Yeah, I got two actually.
Yep.
The first one is, do you consider like POIs that have that are at the Asian high or Asian low, or you expect them to get swept before you like trade?
So I don't trade London, so usually that stuff doesn't apply to me. The thing with the Asia high and low, it usually happens to be some form of inducement. What I look for is if this is my POI, where's the inducement? In this case, it's that. If that inducement happens to be the Asia high or the Asia low, that's fantastic. I'll use it. But I don't sit there and I'm like, oh, this is the Asia high, this is the Asia low. And what happens is the whole theory is this. Asia consolidates, London runs the liquidity, everybody gets induced into the wrong side of the market, London turns around, we get to New York reversal happens, and then the London momentum continues. That is the theory that everybody puts out there. This theory holds true sometimes, but not all the time. And a lot of guys in my group have even told me the Asia sweeps really been screwing them a lot lately. And the reason being is nothing in the market's consistent. Don't marry the bias that Asia's liquidity needs to be swept. It will get swept at that point. At some point, it doesn't mean it's today or tomorrow. Just like I know this low is going to get run at some point, it doesn't mean it's happening this day. We have to look at the market as what's happening in front of me right now that I can see. And it's like, it's no different than, let's say the US news comes out and the US news makes, US news is supposed to turn euro dollar bullish. Okay, it probably will for a little bit, but more than likely what's going to happen, it turned it bullish to retrace and market structure will ultimately take over. So rather than being like, well, the US dollar is bullish and euros or bearish and whatever, the euro dollar is going to go up, don't marry any kind of bias. Look at the candlesticks that are printing in front of you. Same with the Asia sweep and London sweeping and going. This theory plays out for sure, but it doesn't play out every day. And don't marry any bias. The best thing to do is pretty much forget the theory because it will burn you.
Okay.
Hold
Yeah.
on. Do you use trade management EA and is available for people to subscribe to your group? I do use trade management software. To my knowledge, none of them are free. The only way to get free trade management software that I know of that works is you can use CTrader if your broker allows it. A few brokers have it. And I believe CTrader has all the risk management options that trade management software does it. So you will not get trade management EAs for being in our group because we don't own the software. We actually buy it from the software makers themselves, every one of us. How do you deal with trading a lot of pairs at the same time? What is the best time frame to do so? Honestly, my entry criteria is so tight. Like what I showed you guys with the body breaks and the chalks in the beginning, just that alone, sometimes I'll be like, okay, well, I can't look at gold and I can't look at NASDAQ. The only thing I might have a trade on today is Euro USD or GU. So what I do with a lot of pairs is I pull my POIs, I get my directional bias, and then I'll set an alarm. So I'll set an alarm here. And if I have and I'm waiting for another POI here, I set an alarm here. I leave this pair. I go look at the next pair. I'm like, okay, well, I want to know when GU gets here. I set my alarm. I want to know when GU gets here. I set my alarm. If my alarms don't go off on this pair, I don't need to be on it. So that's how I deal with it. In the morning, it takes me about 20 minutes to analyze what direction I think things are going. Now, if within an hour or two of being in the market, things change, I change my analysis and I change my alarms. But I don't need to sit on all four screens. I will sit on the screen that gave me the alarm and I'll be like, okay, now I'm waiting for a chalk. It's in my zone. So I'm just going to watch gold until my trade goes. And if some other alarm goes off in the meantime, chances are I'll just stay on gold. So if you do your alarm setting, your analysis correctly, you're not actually ever looking at four pairs. Your chances are you're only looking at one or two at a time, because gold might give you a trade at the beginning of New York. Euro might give you one an hour before. GU might not give you one that day. You're never truly looking at four pairs. So I don't get too flustered by it anymore, because I don't really care what GU's doing while I'm not on it. If my alarm doesn't get hit, chances are my trade idea is not working out, so I don't need to be on that pair for that day. Do you execute your limit or market execute? I use both. So I use limit orders and I use market executions. Both have their advantages. So with market executions, my hit rate's higher, but I have to take bigger stops because TradingView is about 2 seconds behind my broker. And by the time you eat slippage and everything, market executions make less R's, but they have a higher hit rate. Whereas limits get you a good price and you don't really eat much slippage very often, but your hit rate's a little lower. So they both have their place. I use both. I don't marry one or the other. Do you use breaker blocks? Yes, I do. Do you Confisery Wyckoff? Do I use Wyckoff? I don't. In a way, if you think about it though, we all use Wyckoff in some shape or form, because Wyckoff's really what smart money is. Wyckoff simplified more or less. Hold on, where is, so if you got some kind of a chart, then you get your spring, you come here, you break all these highs. The expectation now is that we're breaking these, that this is the spring. At some point, we're going to come retest this area and we're going to continue up. And the way Wyckoff is taught, you wait for the spring, or if you go in the other direction, you wait for the UTAD, which sweeps all the liquidity, and you get a break of this. And you, on the test of the UTAD, you continue on down. So if you really think of that theory, all they're waiting for is a liquidity sweep and a break of structure, which is pretty much a higher time frame chalk if you were to simplify it. So to answer your question, yes, in a way we all do use Wyckoff, but I don't sit there and mark every Wyckoff scenario. I don't need to. I have tried it. I bought a couple Wyckoff books. I took a couple Wyckoff courses, and for me, supply and demand is just a simplified version. But in all, we all trade Wyckoff in one shape or another. What is the difference between a fresh and original level? And must there be liquidity sweep before considering an order block? So this is how I look at it. Let's do a little bit of drawing here. If the market is continuing down and we have a POI here, we have a POI here. This one's probably got some wicks. This could be used as inducement for the POI above. This POI here might have inducement somewhere down here. So I look at, is the inducement intact? And if the inducement's intact, this POI's got higher probability holding. Now for freshness of the zone, I have a rule. If it taps in once, I'll take a trade. Taps in twice, I'm okay with trying to trade. Taps in 3 times. This is the absolute last time I will use this POI. If it comes back and taps in the 4th time, I am not interested in using this zone. And what happens a lot of times is, you know, while we're asleep or whatever, this order block's already been tapped once or twice. So what I do is I look at it and see how many times it's been tapped. The more times it's been tapped, the weaker it is. I don't use the supply or demand zone that's been tapped more than 3 times. Do you trade your own capital or funded? Both. What is the max pip for your stop loss? honestly, man, it changes for every pair all the time. I could take a trade with as little as 1 pip on euro if I'm trading Tokyo and the candles are small, let's say, or I could take a 7 pip stop on euro because it's in line with 4-hour order flow and I got such good pricing. It all depends on what my entry criteria is and what the POIs are like. Generally on euro, somewhere between 2 to 2.5 pips is average. GU anywhere from 2.5 to I'd say 5 is pretty average, sometimes 6 or 7. With NASDAQ, this pair changes a lot. So for me, the smallest NASDAQ, let's see, I say the smallest stops I get on NASDAQ are probably about 8 points, and I'm willing to go up to, you know, if it's in line with 4-hour order flow, I'll go to 30 points. Can you please throw more light on inducement? Yeah, absolutely. Let's see if we can actually find an example. So if we look at this as a supply zone, you can see here we have a bunch of wicks and a bunch of resting liquidity. And then you get a little bit more. This to me is all inducement. Now this you could consider the first tap. The market could tank off of that. If this fails to give it a push down, the expectation is that this becomes inducement as well, and this will come back and likely tank. So the whole concept is with inducement, we want to see some sort of a pullback on a time frame. So if I get some kind of inducement dropped, and this would be inducement, this would be inducement. So if the market dropped all the way down here, this is likely just a liquidity grab. And if this is in the direction of the 4-hour, the market will likely continue on up. So that's the only way I look at inducement. Now, the other way of looking at it is if the market just went up and there was no pullback of any sort and there's no inducement, if this comes down here, I'm a little bit leery about this POI because there's a chance that this POI may not hold because there's zero inducement. Will I try a trade off of it? Yes. Will I try multiple trade ideas off of it? Very unlikely. Do you always wait for a chalk on the 1 minute, or do you? I wait for 30 and 15-second chalks, depending where we are in the zone and how safe of an entry it is. I may not even use 15-second and only use 30-second for that area. If you're taking hard TP at 5R, would you advise somebody to partial at some point before 5R is hit? So I think a lot of people got really misunderstood the 5R concept. And hold on a sec here. No, I haven't traded synthetic indices, and I probably never will. The whole idea of 5R, the concept was we've came up with the concept for people that didn't know where to partial their trades out. So let's just do this simple. We'll go. All right. And we'll go. Cool. So let's stretch that out. So the whole concept of 5R was for people that have don't know where to take profits or partials, for people that don't know how to risk manage properly. The concept of 5R was just a simple idea that, hey, most of the time with a 2-pip stop, I know I can get a 10-pip travel run with euro. With GU, most of the time with a 3-pip stop, I know I can get a 15-pip travel. Now, let's say my stop happens to be 5 pips on euro. I'm probably not going to go for 5R because chances are, unless it's in line with the 4-hour, it's not going to work out. But people took this concept as I hard TP every trade at 5R. That's not the case. If we're counter trend or we're poorly priced, I will take a 5R hard TP. If we're pro 4-hour trend, what I'll likely do is take partials at 5R and run to at least a 15-minute target. You know, if it's 13R, I'll take partials at 5R and leave the rest run for the rest of to hit the higher time frame. The concept of 5R was created for people that don't know where to take partials. Pay yourself at 5R, pay yourself at 10R, and then TP hit. I think a lot of people really took that concept and turned it into that our whole Discord only 5R hard TPs. That's not the case. It was more to teach people discipline and to help beginners have a system of always getting paid. Because something we struggle with a lot of people that come into our communities, they don't know where to take partials or where to close their trade. So 5R gave them a starting point. Some of our guys, you know, take partials of 3R or 4R. You have to test and see what works for you. But it's just to give you the building block to create your own system. You don't need to use 5R. It's a systematic approach to how you could partial out and ensure you're getting paid. What's the best pair to trade, and do you advise I take multiple pairs? If you're brand new to trading, I would start with one pair, and I would probably test a US major. Euro USD to this day is my most profitable pair. It provides the most trades. It's the easiest to trade. I would advise you to start taking setups on that. It's a very good place to start. Sometimes we may have a chalk on the 1 minute and the 30 seconds, then price doesn't respect the POI. See how do we choose the right POI after the chalk, and precisely what chalk is the right chalk inside your higher time frame supply or demand. There's really no right answer for this, and this is kind of how it goes. So you have your supply, and you know, price comes in here, it chalks. And now this chalk usually presents you with a entry here, and you have another entry here. And both of these are probable trade ideas. Now the next probability is it comes through both of them and chalks again and then goes. There is nothing I can tell you that says this chalk's guaranteed to hold. It's a game of probabilities. What you do have going for you is looking at momentum and candlestick language and what pair you're trading. So more often than not, with a pair like GU, it comes to the extreme. So it'll come here. More often than not, with a pair like EU, it'll come to the decisional. What I ultimately look for is the initial reaction point. So if there is a reaction point in here on the demand, there's going to be some sort of it's going to come in, it's going to wick in here, and then it's going to go up, and then it's going to come and break through this demand. I'm going to look at exactly where's the supply zone that took out this reaction point that initially reacted in that supply. Now with that comes your pair's characteristics. I know gold goes more often from the extreme. Sometimes from the decisional, but more often than not extreme. NASDAQ's usually extremes, GU's usually extremes. EU does not like the extremes as much, so my higher probability is down here. At the end of the day, it's a game of probabilities, and you have to just follow your trade plan. So for me, if I took one loss here, I'm willing to try one more here. Now, if I take two losses on the same POI, I scratch my idea. I don't take another trade. Even if the third one goes, chances are I need time to cool off. So I have a rule where I do not take more than two losses off the same supply or demand. What this does for me is lets me cool off, lets me find another trade rather than entering a third trade, you know, 5 minutes after I just lost to. You're not level-headed, you're not clear, so you got to set some kind of ground rules. You're playing a game of probabilities. There's nothing anywhere that's going to tell you this chalk's going to work more often than not. Some of our members in our community have a rule that they don't take the first chalk because the first chalk's usually inducement for the second. And usually they'll wait for the second or third. Myself, I don't have a problem with trying the first chalk, but if I try the first and second, they don't go, you won't see me in the third. And sometimes the third goes, and that is the life of a trader, guys. It's manage risk. It's play your probabilities the best you can. How do you pick between decisional and extreme? That's literally what I just talked about with the reaction point. I think then I have to join your group. A lot more to learn. Yeah, honestly, guys, there is so much fine tuning. And the other thing you're going to find with our crew is we do have multiple coaches. So this is my view on the market. You know, we have another coach, Brian. He's got different views. He's 90% like me, but then he's got a couple of his own little things he does. And then we got Nathan, our other coach from Ireland. And Nathan, again, is 90% the same trader as me, but he's got his own little hacks that he uses. And that's what your job is. Take what we put out for knowledge and turn it into your own system so it feels natural. So if I did my job right and you were in our Discord, you would likely trade, 80 or 90% like me, and then you put your own spin on it because something in your own testing said to you that this works better for you. So ultimately that comes down to you. Can you please shed some light on how you scale and trade? So, I'm very tight with how I enter a trade. So if let's say we get our chalk here, we enter our first trade here. And at this point, what I'm going to look for is I'm going to look across here and see where the next demand zone is. Once this demand is broken, I'm going to find another supply zone that broke that demand zone. And ultimately, I would be willing to scale in that position. There is a criteria to be met. For me to take a second position, the first one has to be break even. Partial staking if possible, but break even. Once you enter this position, I will not scale in anymore on that leg. Also, if this keeps going down and, keeps breaking demands, I'm probably not taking this entry. I'm not taking the next flip entry. I'll take the first two. After that, what I need to see is something on the higher time frame, create another supply zone on the higher time frame, and I want it to tap that zone, re-chalk on the lower time frame, and only then would I enter again. I will not keep scaling into 1 minute or 30-second positions all the way down the legs, because at the end of the day, higher time frame rules everything. And we know that more likely than not, your trading time frame, which is your micro analysis between 10 to 30 minute, we're waiting for one of those POIs to get hit. So the further away we are from this initial POI where the impulse began, the lower probability your scale-ins will have. And once you're down here, you want to wait for a new supply zone to get created and get tapped, and only then would I continue on scaling in. What is a decisional? So if we go back to the whole chalk theory, if you had, let's say, a demand here, you're going to have often a supply zone here that broke it. That's your decisional, or you're going to have the extreme. Sometimes you'll have two different places. And yeah, the extreme, the top one would be the extreme. This would be the decisional. And that basically comes down to testing your pair and its characteristics and seeing, what is the pair I'm trading? What is it more likely to do? Euro dollar, it's not as likely to come to the extreme as GBP USD. It's just not in that pair's characteristics. The more aggressive the pair, the more likely it is to come to the extreme. So hopefully that makes some sense. Honestly, guys, I do appreciate everybody showing up here. We're probably gonna cut this short. Honestly, if you guys want some more knowledge on this, want some more content, we do have a free YouTube you can check out. The link is in my Instagram bio. If you want to take your trading to the next level beyond that, get into our community. We have a lot of stuff going. constant new content. Like I said, we have multiple coaches. And then the last thing we're doing is we do a discipline trader challenge every month. And that's where we're taking our guys that are over trading and we're hooking up MyFX book to demo accounts and we're actually monitoring their trades. We just finished our first one and we've had traders that were taking 20, 25 trades a day and we've gotten them down to 2, 3, 4 trades a day now. And ultimately, you know, trading is very systematic. So it comes down to the discipline. And as someone that's been in multiple communities coming up, not one community ever did anything like this. So that's kind of one of the things we did to separate ourselves. You guys are more than welcome to come join us. We do have a deal running for today, tomorrow, and Monday, where it's $200 for 3 months. If you guys are interested, message me, let me know, and we can help you take your trading to the next level. Other than that, I do appreciate everybody coming out. And what I'm going to do is I'm going to post this video on YouTube. And anybody that wants to rewatch it or anybody that wasn't able to make it, they'll be able to replay this. And hopefully a lot of you guys can gain some extra knowledge from this. And hopefully I'll see some of you in the community. Thank you for coming out, everyone. Have a good weekend.
Thank you.